Hello, this is Colin Wali and Henry Becker with Lighthouse Wealth Management. Today, Henry and I are going to have a discussion about the first half of 2016 from a market and global macro perspective. We will wrap up with a quick discussion of risks and opportunities going into the second half of 2016. So Henry, the first half of 2016 has been a roller coaster. Can you give us a high-level review of the first half of the year from a market perspective?
So from the beginning of the year, we had the Fed interest rate decision to bump interest rates up, which was a bit of a drag on the economy and the markets in the end of the year, dragged through into the beginning of 2016. And then we also had oil prices began falling in 2015 and continue to fall through 2016. And again, a bit of a drag on the economy, although a positive for people at the pump, it was a negative for the economy. But since we started with one of the worst Januaries on record, the market has now rebounded a bit, quite a bit actually, into the summer now.
Do you think the Brexit vote was just market noise, or do you think there was more substance to the vote?
So the Brexit vote certainly took people by surprise. Most people were thinking that the British would stay in the European Union. So as we indicated in a note shortly after the Brexit vote, the likely impact is not going to be impacts, will not be felt for months, maybe even years. It's going to take a while for the UK and Europe to redo trade agreements. But the pickle that both parties find themselves in is if the Europeans make it very easy for the British to leave the European Union, then other countries might wise up and say, well, we want to leave too. Or if they're too hard on the British, the Europeans are too hard on the British, it could justify to other outside parties saying, well, why? That's why the British left. It's the bureaucracy, the heavy-handedness of the European Union. So suffice it to say, we'll see what happens in the future.
Can you give us cliff notes on the global macroeconomic picture?
The answer to the global economic question is uncertainty. In one word, it's uncertainty. And the reason for that is we're well off of the lows from the financial crisis in 2008 in terms of stock market. We've been at zero interest rates for more than 8 years now, which means the bond market and real estate prices are going to be near all-time highs because they are very sensitive to interest rates. And when rates are this low, those assets are going to increase in price significantly. So after 8 years of zero interest rates and all the economic stimulus around the world, the global economy is still relatively weak in producing subpar growth. And with that said, it doesn't mean that we aren't going to have the opportunity for gains. It just means the rate of change in gains in the stock market, bond market, are probably getting close to a plateau.
Let's talk risks and opportunities. How about starting with risks?
So in terms of global risks, I'll put it in three buckets. First bucket is going to be a central bank misstep. After, again, many years of zero interest rates and lots of economic stimulus and misallocation of investments and so forth being made because of zero interest rates, cheap money, cheap credit, it very likely could be we see a central bank misstep. When we're dealing in trillions of dollars, trillions of yen, trillions of euros, even a relatively small mistake can amount to something large. So central bank misstep would be one. Number two would be Brexit. The effects of Brexit are probably off into the future, months, perhaps years. It is unprecedented for a country to leave the European Union, so nobody has any idea how this is going to shake out. And last would be China. China's economy is slowing down, and it's taking a lot of energy, quite frankly, for it to slow down. And it's a significant issue to the global economy if China truly has slowed down, because it's been really the engine driving economic growth globally for the last 20-25 years.
How about opportunities?
So in terms of opportunities, I think probably one of the best areas of opportunity is disruptive technology or disruptive industries. It's becoming a bit of a catchword. We're hearing more and more in the media, but this is not just technology in the traditional sense of the word, like computers and so forth. This is companies that are leading the charge with ride sharing. with short-term vacation rentals, biotechnology. All kinds of different industries are really starting to come out with exciting new, for lack of a better word, technologies. So, and what this means to the broad investing market is over the last 5 or 6 years, you could just invest in the indexes and take the ride of the stock market. But now that, again, the rate of change in the market is starting to slow down, one has to be a little more selective. So perhaps active management of stocks and bonds, more selection or selectivity is going to be beneficial, more beneficial than it's been in the last 5 or 6 years. So from a smaller sense, disruptive technology or disruptive companies. From the larger sense, active management of investments is probably going to start taking hold.
Thank you, Henry. We appreciate the discussion today. As always, if you have any questions, comments, or concerns, please feel free to reach out to us.